Welcome to the deep dive. Today we're jumping into Anywhere Real Estate, ticker HOUS, and their Q3 2025 results.
Yeah, the earnings call was pre-market, November 4th. And look, it laid out this really complex picture, didn't it?
Absolutely. It's not just about the numbers themselves.
Right. Our mission here is to look past the basic P&L. We need to really dig into how well they're actually running the business day to day. And maybe even more critical is this huge strategic story around the merger they're planning with Compass.
That merger looms large over everything.
Totally. And it sets up this perfect paradox we need to figure out. Anywhere reported a significant GAAP earnings miss, but the stock, it shot up, closed the day up almost 7.8%.
Yeah.
Okay, so let's unpack this. What exactly did the market see that made them cheer despite that headline miss?
Well, that paradox, like you said, it's really the heart of the story. It just perfectly highlights the gap between the underlying business momentum and some, let's say, very technical accounting adjustments.
Okay, hit us with the headlines first then. All right, so revenue came in at $1.63 billion. That was a solid beat compared to the $1.53 billion consensus.
So about $100 million better than expected.
Exactly, and that's up 6% year over year. So, in this kind of environment, that's a clear operational win.
Okay. Operational win on the top line, but the bottom line, using GAAP, told a different story.
Yeah, that's where the disconnect is. GAAP earnings per share was actually a loss of 12 cents. The street was expecting a gain of 18 cents.
Oof, big miss.
Big miss on paper. Now, adjusted net income, which kind of smooths out some one-offs, was basically flat, near zero. But their preferred metric, operating EBITDA, landed right at $100 million.
So what caused that GAAP loss then, if operations seemed okay?
Right. This is where it gets interesting. And it's really the technicality that explains the market's reaction. The main drag was a $24 million expense related to their cash-settled restricted stock units, RSUs.
Okay. Why was that expense so high?
Because Anywhere stock price went absolutely nuts in Q3. It was up 193%. That massive run-up directly increased the mark-to-market liability for those RSUs. It's a non-cash charge, basically.
Huh. So wait, the company's stock doing incredibly well is what caused the accounting loss.
Precisely. It's kind of fascinating, isn't it? The market saw through that immediately. They recognized it wasn't a fundamental problem. It was just, an accounting side effect of massive investor enthusiasm.
That raises a question, though. If management saw the stock running up like that, couldn't they have, hedged that RSU exposure somehow to avoid the accounting hit?
That's a fair point. I mean, they manage operational risk all the time. But this kind of RSU accounting, it's pretty standard for employee comp. Yeah. And hedging against such an extreme price move tied to big news like the merger, that's really tough and maybe not even the best use of capital.
Okay.
The market basically said, we get it, it's paper loss driven by excitement. Let's look at the real business.
All right, let's do that then. Let's dive into that operational signal. You mentioned volume growth.
Yes. First growth in closed transaction units since way back in Q4 2024. Overall, closed transaction volume was up 7% year over year. That's a solid sign the market might be thawing.
And was that growth broad-based or concentrated somewhere?
Definitely concentrated. And management really hammered this point home. The real driver was the luxury segment.
Ah, the high end.
Exactly. Their luxury brands saw 12% year-over-year volume growth. And get this, just in Q3, they sold 345 homes priced at $10 million or more.
Wow, 345.
Yeah, that specific ultra-luxury slice was up 30% from last year. That segment is clearly less sensitive to small mortgage rate moves, and it's a definite strategic focus for them.
Makes sense. And the agents making those sales happen, how's that side looking?
It's really strong. The advisor's business revenue was up 7%, mirroring the volume. And they're bringing in talent, recruited nearly 500 productive agents in the quarter alone.
Okay, recruiting is one thing, but are they keeping them?
That's maybe the most impressive stat.
Yeah.
Retention hit almost 95% for their top half of producing agents. Management called it one of the highest rates they've ever seen.
95%. Why now, though? Is it just the stability the Compass merger might bring? Or is the stuff they're doing internally, like the tech and AI, actually making agents stick around?
I think it's going to be both, right?
Yeah.
The merger offers that future scale, which is appealing. But the fact they're holding on to top agents now in this market, it suggests their investments in making the agent's job easier are really paying off.
And are they having to pay up more to keep them happy? Commission splits?
Surprisingly stable. Splits were at 80.7%, which is only up about 30 basis points, 0.3% year over year. It shows agents are getting good value, but the company isn't seeing runaway cost increases there.
Okay. So the core brokerage, especially luxury, is doing well. Agents are sticking around. What about the other pieces of Anywhere?
Yeah, those diversified businesses add nice resiliency. The franchise business, which is high margin, keeps growing. They added 13 new U.S. franchises. And the title group, their closing services arm, saw revenue up 7%. That's important because it's tied to transaction units. And they said it generates about $3,500 per unit. Adds up.
And Cartus relocation, that always seemed like a quiet engine for them.
It still is. Serves almost a third of the Fortune 100. It keeps growing, and crucially, it feeds really high-quality leads back into their agent and franchise network. It's a good flywheel effect.
All right, let's shift to strategy then. You mentioned AI and tech helping agents. They seem pretty serious about this.
Oh yeah, very serious. They're pushing their AI agenda hard. It's got two main goals: make agents more productive, like we discussed, and cut long-term costs, which, feeds right into their savings targets.
Do they give concrete examples? Sometimes AI feels a bit fluffy.
You did, actually, two really good ones. First, an AI tool that basically reads and automatically inputs listing agreements into their system.
Okay, so what does that mean
It
practically?
means what used to take an agent maybe 10, 15 minutes of tedious data entry per listing now takes under 60 seconds.
Whoa. Okay, that's not fluffy. That's real time back in an agent's day. Multiplied across thousands of agents and listings.
Exactly. That's a genuine efficiency gain. It improves the agent experience, frees them up to sell.
That was a second example.
That was more back office focused. Automating transaction processing for Coldwell Banker documents specifically. They said 50% of those docs are now fully automated,
50%. And that's up from.
up from about 1/3 just last quarter.
Yeah.
So rapid progress on streamlining the paperwork side of things too.
You can really see how that AI focus positions them for the merger, right? Proving they can use tech to integrate and cut costs is key.
Absolutely. Which brings us neatly to that second strategic pillar, the merger itself and the overall financial health.
Right. The Compass merger. Still planned for the second half of 2026, assuming it gets through all the approvals.
Yeah, it's a long road. And because that deal is pending, management did the smart thing. They suspended specific forward-looking guidance on revenue and EPS.
Makes sense. Why guide to numbers that'll be irrelevant post-merger?
Exactly. The message was very much, we're focused on executing now, hitting our internal targets, and getting ready.
And how are they doing on those internal targets, like cost savings?
Pretty well, it seems. They're on track for that $100 million in cost savings for the full year 2025. They said they've already identified all of those savings,
Okay.
and they've already realized $67 million year to date, so more than halfway there in actual booked savings. That builds confidence.
And the balance sheet. Can they handle this long wait for the merger financially?
Looks pretty solid. Free cash flow in the quarter was $92 million. They're actively managing debt, bought back another $22 million of some exchangeable notes, and paid down the revolver by almost $200 million. Plus, no major debt maturities coming due until 2029. So, yeah, they seem financially stable enough to navigate this period.
Okay, let's try and connect all these dots. We have okay operations, luxury strength, good cost control, this weird gap loss,
Yeah.
but a happy market. Why the bullishness? Is it just the macro picture improving?
The macro is definitely part of it. Management pointed to mortgage rates easing off their 2025 highs, and we are seeing some signs of life in existing home sales. An AR reported a small jump, like 1.5%, month over month in September.
So a bit of a tailwind starting to form.
A potential one, yeah. So putting it all together, what this positive stock reaction tells you is that investors are basically underwriting two things. One, yes, slightly better housing activity ahead.
Okay.
And two, maybe more importantly, they're buying into the long-term potential of this combined Anywhere Compass entity. The scale, the tech platform, the synergies down the road, they're valuing that future possibility today.
So the mood is kind of cautiously constructive, looking past the short-term noise.
I think that's a perfect way to put it. They're betting the combination creates something really powerful and efficient, maybe even before the deal officially closes in late 2026.
And we have to remember, the stock was already way up, right? Like 94% over the 3 months before this call, mostly thanks to that initial merger news.
Good point.
Yeah.
This reaction is building on existing momentum and a narrative the market already bought into.
Okay. Given that massive run-up already, and the fact the merger is still, potentially years away with lots of hurdles, the risk versus reward here feels pretty complex.
Definitely tricky.
Which naturally leads us to our "this is not financial advice" segment. Time for an outrageous but maybe plausible trade idea based on everything we've just discussed.
Let's hear it.
Okay. My pitch leans hard into accelerated synergy capture. The idea is this. Both HOUS and Compass are already pushing AI pretty hard on their own, right? We talked about the document automation, the agent time savings.
Clear progress on both sides independently.
So the bet is that when they actually combine these platforms, the synergy isn't just the $100 million they're currently targeting. The bet is that the tech integration happens faster and unlocks way more efficiency than planned.
Okay, so you're betting on positive surprises from the integration.
Exactly. So the outrageous pitch is take a leveraged long position, maybe something like long-dated, out-of-the-money call options on HOUS, the thesis. The market starts rewarding the potential for massive platform value creation well before the second half of 2026 closing date. You're betting that combining these AI initiatives generates, say, an extra $150 million in annual efficiencies on top of the current targets, maybe within 18 months of closing.
Wow. Okay. That is aggressive. You're essentially betting on a near-perfect, super-fast tech integration before they've even finalized the plans.
Pretty much. Betting on speed and compounding efficiency gains.
The risk, obviously, is huge. If housing stalls again, or God forbid, the integration hits snags, gets delayed, costs more, that kind of leveraged bet blows up fast.
For sure. High risk.
But if you're right, if those AI tools really do mesh quickly and unlock savings faster than anyone expects, the payoff for anticipating that could be, well, significant. It's a bet on velocity.
Exactly. Purely a thought experiment, of course.
Yeah, of course. Okay, so wrapping this up, Anywhere delivered decent volume recovery, really strong luxury performance, and showed they're serious about hitting that $100 million cost savings target. That stuff basically offset the noise from the technical GAAP loss.
They're executing while they wait.
Right. Which leaves the big question for you, the listener, going forward. Will this easing in mortgage rates and these little green shoots in housing be enough? Enough to keep the stock's momentum going through what will be a very long wait for that Compass merger to actually close?
Yeah.
The focus now really shifts, doesn't it? It's all about the pace of the housing recovery data prints and any news on merger milestones. It's macro meets execution meets regulatory timelines. Lots to watch.